You got Mr. Scott Forehand and you got Mr. Jonathan Daly joining me from the Forehand Agency. Their website, forehandagency.com. Their phone numbers, 757-278-1264, or toll free from anywhere, 1-800-677-0989. That new website, again, forehandagency.com. And what are we talking about this hour? We're talking about your money, of course, with Mr. Scott Forehand on News Talk 790. WNIS. What's going on, man? Welcome back.
How are you?
Oh, we're doing good, man. Good to be talking with you.
I would just like to say happy Saturday.
Happy Saturday as you join us via the magic of the interwebs because the city of Norfolk has decided to have yet another parade. And I am trapped. I'm literally being held hostage at work this morning. I don't know when I'll be able to go home. So
I did that one time before because you guys didn't let me know that there was a parade. So I got to hang out in the parking
yeah.
garage for 3.5 hours. And I wanted to thank you for that experience. I
I
don't
don't think
know.
I don't think we even knew that there was going to be a parade.
Right, right. Well,
Surprise parade.
is it really your responsibility to notify me? I should be aware of my surroundings, and I should have known when I was pulling in with all the police and all the cones and the floats off in the corner that maybe there's going to be a problem getting out of here, but I didn't think of it. And so I got to spend 3.5 hours in your garage, which was
Yeah.
awesome.
Pretty garage.
Yeah,
It's,
yeah.
that's a Seinfeld episode, I'm pretty sure.
I'm sure it is. Yeah, but I wasn't carrying around an air conditioner or a goldfish. I know that episode. Very cool. So, Mr. Foster,
Yes, sir.
we're going to do this the way that we normally do this. We got a lot of stuff to talk about. Going to go over some charts to begin with, and I've got my broker, advisor, friend, confidant, colleague, coach,
Athlete.
um, Mr. Jonathan, Coach Jonathan, the Jonathan Daly is with us today, as always, shaking his head. Yeah, man, come on, you earned some kudos as you continue to do. Appreciate you being here.
Yeah, it's my pleasure to be here. I think nobody edifies like you, Scott, and I'm just shaking my head. Yes, like you can do better. Come on, keep it up. You can do better. I think partner in justice was left off the list, but I'm happy to be here,
I forgot King of the
swinging the
World
sword for
too.
you. Oh no, no, not
King of the World.
King, Prince. I'm
Oh,
just
I'm
second
sorry,
in
yeah, Prince of the
command.
World, right?
Yeah, and yeah, heir to the throne. Fantastic to be here. Love talking with you guys, and we're gonna have a good day.
Yep, we're gonna
Like
have
you
a good
said,
time.
happy Saturday.
All right. So, big question, right? The market's going nuts. The Fed still hasn't dropped rates. President Trump is still on a rampage. There's all this stuff. We've still got a major war that could potentially blow up into something bigger. We've got a another thing with the Hamas Israel thing going on. Who knows where that's going to go? So there's a lot of stuff that can push us down the wrong direction quickly, and there's a lot of positive stuff that's pushing us up. Nobody's got a crystal ball that works, me included. All we can do is look at the history and look at the current performance and just try to gauge on the current market what's going on and where this thing might go. So, as always, I have about 6 or 7 charts that I go through that I'm going to look at. They're going to give me maybe some insight. And first thing is the word recession. Even though we're in a crazy market right now, the word recession still comes up. And why? It's because the market needs to reset. It needs to reset every couple of years, and it has historically for the last, well, since the market's been in the market. And I'm going to go over that in just a minute. But the resets sometimes are heralded by a change in the market. So here you go. The last official recessions for the market: August 57, April 60, December 69, November 73, January 80, July 81, July 90, March '01, December '07. Those are the last official years when we had a identified recession by definition. The definition of recession has to do with GDP and a couple other factors. So if I look at what's going on with the GDP and I look at the history of recessions, there is a congruence. And here's what I'm talking about. The GDP for 2023 and 2024, what wasn't bad. The consumer spending was up 2.1%. The government spending was up 0.7%. The residential spending was up 0.1%, believe it or not. The business spending, the business investment, business infrastructure investment was up 0.2%. And finally, information processing, that's building new plants, getting ready for AI, building out the technology and the infrastructure for those facilities. All that was up in 2023 and 2024. Here's the problem. The amount of consumer spending for 2025 is down. It's actually cut in half. And where you can say it's a timing thing, okay, well, we are through 9 months we're through 3/4 of the year. We should not be down by half. We know that Q4 is a big spending time. We know there's a lot of money that comes in Q4, and that's going to increase those numbers, but it's not enough money to make up the half that we're not at. So there's the first alarm bell I have. Second alarm bell, where we were for government spending at plus 0.7, we are now minus 0.1. We're going the wrong direction. Number three, we were up residential wise 0.1. Now we're at minus 0.1. Again, going the wrong direction. For business infrastructure build out, we were up 0.2%. Now we are down minus 0.2%. And I'm talking, of course, all those investments that, when Trump did his tour and came back with all those countries that were going to invest in infrastructure in the US, none of that's happened yet. And that stuff takes time to get to. So we're not seeing any of it yet. But right now, it's at minus 0.2%. The only other thing that's actually really good, and this has started in 23 and 24, that's that information processing equipment piece. The big build out of all these massive AI centers. That is not a 1 year process. That's a years long and maybe even a decade long process that's going to happen. That's why we were up in 23, 24, 0.1%. We're up this year, 0.6, and we will probably finish that somewhere around a full point, that's strong. So we got one thing that's good, four things that are bad. There's my first alarm bell. Second alarm bell, the herald. I talked about this a minute ago. The herald of a recession is a really up consumer spending. Okay? What did I say about consumer spending? Up 2.1% for 23-24. It's only up 1.1% now. If you're graphing this out, that means we were here and now we're going this way. The direction is the wrong direction. And when I see this exact illustration was mirrored in April of 2060. It was mirrored in January of not 2060, 1960. It was also mirrored in 1980. It was mirrored in 1990. It was mirrored in 2007. If anybody remembers 2007, that was the last really big bubble that burst. That was the 2008 piece where the market lost all that and it took a long time to recover. Okay. So we've got, again, two things they're both saying the same thing. One is heralding as it did in the past, and one is showing, okay, we've got less money being spent. And this has, even though the market is up way high, the country as a whole is spending less money. And that should reflect in the equity positions of stocks. It is not. the I'm pretty convinced that the market where it's at right now is an illusion. We are now 29% overbought per Jamie Dimon. 29%, about one third of the money that's in the stock market isn't supported by general business ideas and practices. That's scary. All right. What else? Okay, so jobs, right? So we're deporting a lot of people that shouldn't that are here illegally, or not to be political, but they're not here legally. Let's put it that way. We're deporting a lot of people. They're getting a lot of the people that shouldn't be here at all, the criminals out, which is great. Okay, and you would think that that would increase the rate at which we hire. You would think that that would create more jobs. It's not. So what we're seeing is the job growth is down. We haven't seen it in the last since February of 22. There's only been two other months where it was lower than where we are right now for job growth, which is I can't explain it. I don't understand. Next, this is interesting, but if you think through the logic, it's again kind of scary. The Russell 2000 is an index that a lot of people follow. It was developed in the 1980s and it's designed to follow US small cap stocks. And the Russell 2000 just posted its high ever, its highest ever. Okay. Great, right? Kind of. Why is it great? What does that mean? That means that the vast majority of people are putting money into small cap stocks, which is kind of a speculation. Yes, there are gems in there. All stocks start as small cap stocks. They will grow to be large cap stocks and blue chips. That's how the process goes. Um, International Typewriter became International Business Machine. It was a small cap stock as International Typewriter in the 1930s and 40s, and it was now it's a blue chip. And there's that story about the woman who lived in Norfolk, Virginia, whose father bought a couple of shares of International Typewriter when he was in the Navy. They found those shares, and IBM sent them out in a limousine, picked them up, flew them to IBM headquarters, and said, "Congratulations, that stock share that you own has split 240 times since you bought it. You are now the largest shareholder of IBM stock. You ostensibly making you the director of our company. What would you like to do?" Okay, so that's how small cap stocks start and grow. They're great for speculation. The problem is that's what's happening. A lot of people are speculating. And it's not, if we talk about the employment stuff, it's not because we're more employed. We're not making more money. We're just putting more money at risk in small cap stocks. So that means that when those stocks get evaluated to where they are, unfortunately, a lot of people that have been putting money in there are probably going to lose a substantial portion. And if you're moving money, and this is where, Jonathan, what you and I do, if you have and you've directed your advisor to start putting money into those stocks through your 401k, or you've got a US small cap position in your TSP or in your 403b, that's a problem. And it's something that should be considered. If you want to do it, there's ways to gain access to it without writing the stock down. You got any comment on that one, Jonathan?
Yeah, just listening to you hear or explain the charts and how they coincide with each other, it reminds me of an analogy. Like, have you guys ever been in a large group going out to eat at a restaurant, like 10 or 15 people? Well, each person has their own like personality and does their own things, and we're just trying to kind of look at the group as a whole and predict when chaos is going to ensue. Right? You have that one person who's walking to the gift shop when our table's ready. You have all of these entities that operate outside of each other without necessarily communicating with each other, and you're trying to judge when this reality show is going to turn into a drama. And there's a lot of predicting factors, like you had mentioned. You say, one in the right direction, four in the wrong direction. You got the kid hopped up on candy, and it's a lot to try to control, right? There's a lot of speculation. Who's doing what, and when is it going to go wrong? And with the labor market, going in the wrong direction, and with hiring slowing down and consumer spending following, but stock prices going up, for an economist, it's a nightmare. It's one of those, it feels like dad's putting it all on black, right? It kind of reminds me of, the housing market bubble where people invest in real estate. The getting's good, the getting's good, the getting's good because we're trying to turn a dollar into five. And it's only a matter of time before black doesn't hit, right? So when in our side of the table, we talk about mitigating risks, that's exactly what it is. We take the speculation, we're looking at the big picture, we're looking at the puzzle, we're saying these pieces don't fit. And we can say it, every day, and people can come back and say, well, the market's at a record, and buy into what the scoreboard says. But at the end of the day, if you don't know what puzzle you're looking at or how to observe this group of 15 people, then you need a professional to help you navigate it and walk you through it. And I love these shows because we can talk about the important pieces, but at the end of the day, it's just to let you know that we know what we're talking about. We're not going to fix your financial situation by listening to an AM radio podcast or sorry, AM radio show. You're going to get the insight to know that something's aloof, the insight to professional you could reach out to, and then you sit in a one-on-one and let the chips fall where they may. Let the professional look at how the speculation is an inherent risk towards your bottom line and what your goals are. And the beauty is you get to structure it from an observer standpoint to make sure that the restaurant doesn't turn into a drama, things don't blow up in your face, and you're not stuck with the bill, which is the most important part, right? You don't want to order a salad, everybody else gets lobster, and all of a sudden you're paying $150 for your salad because the 15 people weren't communicating properly. So, um, yeah, it's definitely one of those. You're riding a roller coaster. If your money's in the market, if you're watching Fed, yes, there was a recent rate cut towards the end of September, September 17th. There's prediction that there's going to be another one. And it's almost against Powell's, best, what he wants versus what Trump wants versus what the members want versus what the people want, and everybody's got to vote and nobody's making a decision. And it's kind of like you said, we're speculating on all the speculation, and it's good to have a conversation about what
Right.
it means to you as an individual. Love it.
So just one piece of clarity. Powell doesn't control it. It doesn't matter what Trump wants. It doesn't matter what the people want. All that matters is are the seven voting members on the Fed. What do they want? Because they are the ones who control policy, really. And that probably should change. But that's, and I'm not talking revolution. I'm just saying there should be something that takes the power of our dollar out of the hands of seven people that are not elected. All right. So last two charts, if there's you've I've heard this said before, show me the criminal and I'll find you the crime. Okay? That's not the way this should work. But if we wait to find the problem's already happened and it's too late to fix it. So all I can do is again go back and look at history and look at the market and look at what the market did and these other indicators. Do I find what I call as a constellation when I see different types of charts all pointing the same direction? I've already showed you that, that very first chart I went over, four out of five said good stuff, one said bad stuff, or two out of five said bad, three said good. So what I'm looking at now, if you listen to any like any kind of financial news network or anything, you always hear about every month there's a revision that happens about how the country did or where we were or whatever. And there's logical reasons why that revision has to happen because like in the beginning, the number that they come up with that they portray about growth, it's based on voluntary information. It's based on, yeah, I'm with XYZ company and I say we did this. Okay. It's a volunteered information and all of them don't volunteer it. Okay. A lot of times that revision happens after when they file their statements, when they file their corporate documents, and then the federal government can really see what happened. Okay. If revisions are going to happen, they're going to happen every month. It happens every month. The degree of revision is the issue. If if the revision is 1% up, 2% up, 3% down, whatever, that's nothing. That's within the normal parameters of what you'd expect you with standard deviation and all that stuff. I'm not talking about that. That's normal. That's expected. That's actually required. Okay. What I'm talking about is when you see these massive revisions that are coming out of left field, massive revision down 10%, 12%, massive revision up 14%, 27%. And when you'll see again, this whole thing with the constellation of things, when you see a lot of different charts saying the same thing. So there's one, this is about an upward revision. Okay. Upward revisions happen after a recession has started. And I don't mean a 3 or a 5%. I'm talking about a big change. Anybody remember 2008? Big drop in the market. The upward revision that happened in 2008 was 89, 24%. So that means that the numbers were reported down. They revised them up. The upward revision was massive, and we were in a recession. Anybody remember 2022? That's the last big drop that we had in the market. That's when the market dropped 36% in one year and then came back during that same year of 19% up, or 19%, so that it was only down 16 for the year. The revision that happened in that year was 14%. So these are the last two major revisions. And heralding that revision is a peak. And I'm looking at a peak. The last time we were at this peak, 2022. The time before they were at this peak, 2007, right before 2008. So that alarm bell. Next, liquidity. So, what the Fed really controls is access to money. And they control access to money based on the interest rates that they put out there. And if you have a lot of access to money, then you have a lot of investment going on and you have a lot of growth. That's what we're talking about. We're talking about GDP is all about growth. Um, this particular chart has the same issues. When I look at net liquidity, that means how much money is out there that can be borrowed, that can be put invested somewhere or used in a building project or whatever. It's the availability of funds. Where we are right now is we have dropped 22% in the last year in availability of funds. That is a massive drop. The last time this happened was 2022. And the last time this happened before that was 2008. So you're looking, if you're painting a picture of if it's going to go up or down, right? You've got up, up, down, 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 up. Nobody's right all the time. No chart is right all the time. But I see a congruence. I see a lot of stuff happening, and I see it only takes one thing. Russia flies one plane too close to the Polish border and it gets shot down. It only takes one thing. Hamas decides to kill the remaining living hostages and show it on TV. It only takes one thing. Who knows? Okay. So all I'm saying is the market's in a position where the next big move should be down. I'm not saying it's not going to continue going higher. I'm just saying the next big move is probably gonna be down. And if you're at or near retirement, that's what you can't afford because we don't know how long it's going to take to come back to get you back to even. Just to illustrate that, inflation is 3% average. If you lose half of your money because of the market, and then the market comes back to get you back to even, and it takes 5 years to do it. Are you even? You are not, because you lost 3% of the value of those dollars each year for 3 years or for 5 years. You're actually still down 15%. And that's why one of the things that Jonathan and I do a lot is we protect your money. We move it to a place that's a safe place where we don't have to participate with market downturn. We can get market upturn and we can get a multiple of it in some cases. Any comment there, Mr. Daly?
Yeah, I hear you kind of blowing this whistle. I think you've even verbally rang a bell.
Yeah.
Um, and you have this kind of tone, and I just want to ask a question, just kind of like we'll go back and forth real quick, and then we don't know what the market's going to do. Like you say, we just look at signs. When they say exit now, and then you drive past it, and they're like, get off the exit, and then you pass it, and then it's like, hey, listen to me, exit now or else, and you don't get off the exit. Like, you'd mentioned some of the ramifications. If I'm 55 and I want to retire at 60, and I have my 401k is doing better than it's ever been, let's say I just crossed the $500,000 mark, what are the downsides to not getting off the exit? What are the downsides to just kind of staying in my 401k? Let's say I'm 60 and I want to retire at 63. What are the downsides of not getting off the exit, right? Not heeding the signs. Like what's the worst case scenario?
You lose half your money.
Okay, so my 500,000 goes to a 250,000, and you said it takes about 5 years of
Yep.
steady growth even to come back to a 250,000. So now I'm 65 and I'm right where I was when I was 60. It's
You're
kind
not
of daunting.
retiring.
I'm not, because if my goal was 500,000 to retire, then I would have retired at 60. My goal was probably 600 or 625. So if I called you up and I said, "Hey, this is my situation, Scott. I'm seeing these warning signs. I listened to the radio show. What are the worst case scenarios if I do get off the exit? You have my $500,000. I'm 60 years old. What would you do with it?" And let's say this. I'm going to step aside from that question and say, between me and you, if I were to say, hey, in the next 5 years, what are the odds, in your opinion, that there's going to be a correction in the next 5 years?
100%.
Okay, 100%. So you speak with absolute confidence that within some time in the next 5 years, there's going to be some market correction. So if I don't do anything and I'm 60, then before I'm 65, 100%, there's going to be some correction, right? So if I do say, hey, let me
Hold
just
on,
get
hold
off the
on.
exit.
99.99%.
99, sure, sure.
Okay.
It's like Listerine. We
Okay.
always got to account for that, right? For that 0.001%. All right. So say I do call and I say, you know what? The getting was good. It's 500,000, 60 years old. What can you do for me in the next 5 years to protect that money? And what would it be when I was 65 if I decided to kind of step aside and say,
Right.
let's get off this
So
train.
we're not giving advice over the
Right.
radio. However, in a
Sure.
hypothetical example, what the thing we would first need is we need to do an income gap. We need to figure out how much money you're making on the Friday before you retire versus how much you're going to make on the Monday after you've retired. Then we
Right.
need to figure out how much money you want to be making or you need to be making. Then we need to make plans for that. And then whatever's left over, we need to put into a place where you're going to get good yield, and that way we can make it so that your income is ever increasing greater than inflation, so that you're keeping up with inflation. And then hopefully, if Social Security is part of your plan, hopefully it's still around 10 years from now, which is, I mean, they can't let it fail, but it's, I don't know that it's going to be in the form that it's in right now.
Right.
That
So
would be doubtful.
deciding to get off the exit, they have all of these pieces that you're thinking about. You're thinking what I'm making, you're thinking of what I will make.
Right.
So it's almost like deciding to get off the exit means that peace of mind of knowing that I don't have to look at charts anymore,
Yeah.
of knowing that like I don't have to worry. I made it.
Yeah.
It's almost like that, who wants to be a millionaire when Regis tells you, hey, you can't leave with anything less than this. Congratulations. The pressure is off, right? You're not going home broke.
You're set.
So,
You don't have to worry about outliving your money. You'll have as much money as you need for the rest of your life. That's where most people want to get to. They're not worried so much about dying. They're worried about dying they're worried about running out of money before they die. And
yeah,
it's something that's fixable. It's something you can address.
what I love about it is it's like you're opening a Jack in the Box and you got to stop before that thing pops out of the box. And a lot of people,
Yeah.
a lot of people just fall in love with the song.
Yeah.
They fall in love with the song and they like that adrenaline rush of the thing popping out. But in retirement, when it comes to finances, the last thing you want is that guy to pop out of the box. So you can twist that handle all you want. You could do it for the next 5 years if you want, but it is going to pop out of the box. And we're trying to keep it so you don't get scared. No jump scares as we approach retirement, ladies and gentlemen.
Right on.
Mr. Scott Forehand, Mr. Jonathan Daly, live with us until 10 o'clock on WNIS. Their phone numbers, if you want to call them directly and talk about your money with the experts, 757-278-1264 if you're in the Hampton Roads area. That's 757-278-1264. Or if you're outside the 757, that would be 1-800-677-0989. You can also visit their website at forehandagency.com. Scott Forehand is here, and so is Jonathan Dowley from the Forehand Agency. Class coming up on Thursday, right, Scott?
Yes, sir. This Thursday, our monthly class on infinite banking and as an alternative retirement strategy, and also as a way to just to get out of debt. Yep, Thursday
And
at
if people
5:30 Eastern.
and if people want to get more info, all they have to do is call you or head to the website, forehandagency.com,
Yep.
757-278-1264, 1-800-677-0989, 5:30 this Thursday with Scott Forehand. He just might put on pants for this.
I might, but there's no guarantees.
No guarantees.
Yeah. I'll wear a shirt though, for sure.
That's probably a good thing.
Yeah.
Not
So,
not trying to be mean, but that's probably a good thing.
yeah, well, I'm not able to charge people for that show, so I'm not gonna show off this manly physique.
That's right.
All
You
right.
make the rest of us feel bad. What else is on your mind, gentlemen?
Well, it's time for Mr. Daly to talk about something
Yeah.
near and dear to his
We
heart
need
and
to,
my
we
heart.
need to give Dally the floor.
Yes.
Yeah, just I'll steal the microphone for a little bit. So, when we hop on these shows and we put ourselves out there, Scott and I, we always try to separate ourselves from the competition. We want to show you guys, how this is a passion for us. And we want to, be able to give an entirely unique experience to the people who come in and have the conversation with us. And we realize the small group of brokers that not only do we want to separate ourselves, is we want to be very specific about the type of conversations that we're having. So we have this initiative that we call Victor Alpha Solutions, which is aimed at educating, veterans, their families, just hardworking Americans that want to have a conversation that's straight up about what's important to them. And I'm not just talking finances, I'm talking family, I'm talking, obviously retirement, but what we can do to get people in the right track so that they don't have to worry about their financial future. A lot of times, when we meet with strangers, it's a vetting process. We want them to understand that they can trust us. They want them to understand that we know what we're talking about, that we're going to do the right thing. And I think that Victor Alpha Solutions definitely represents that, us putting a hand up that says, hey, we want to have this type of conversation. We're not here to add pressure. We want to know what's going on so that we can get past it. And really, there's a no BS approach to it. And that's why it's aimed at veterans and their families, because we want to get right to it. We don't want to waste anybody's time. We don't want to beat around a bush or sugarcoat things. If your situation isn't great, we'll tell you it's not great, but only so that we could tell you which direction you need to head to get from not great to great. So for those of us here at the Forehand Agency, small ragtag bunch of brokers who really love what they do, we just want to have a better quality type of conversation with the people who really are looking for answers and not looking for fluff. Victor Alpha Solutions is an initiative with the Forehand Agency here. We have ads going out, but you can always get in contact with the Forehand Agency. Let them know, hey, I heard about Victor Alpha Solutions. I want to get straight to the point. I want to get down to the nuts and bolts, and I want to see what I can do as a veteran, a family member, or otherwise, of how I could really just, have somebody I trust. Victor Alpha Solutions with the Forehand Agency is something that just, to me, gets me pumped up because the majority of our founding members are veterans, Mr. Forehand included, and we want to pay homage to that, to that niche, to that individual, to that, and the people who've supported this country and made a decision to sacrifice for this country, and we want to hold a special space for that. So that's what we do with Victor Alpha Solutions here.
Right on. Good job, Dally.
Yeah, thank you. Thank you. It was like a 6.7, 7.3.
I give it a solid 7.4.
7.4. Hey, we're
Right
getting
on, man.
C
I'll go.
average.
Yeah.
I'll go 7-8.
Yeah.
Thank
There you
you. I
go.
knew
Look at
there's a
that.
curve
Winner.
somewhere.
Winner.
Definitely. To the
Yep.
unsuspecting ear.
All right. So last couple minutes, want to talk about we did a long segment on the charts and what's happening with the markets and why having that conversation and maybe taking some of that money off the table is important, putting it in a place where you can't lose it, where you're probably going to get a pretty hefty bonus, 20 or 30% when you move it, and it'll create that permanent income stream and you can count on it. All right, so that's part of it. The other thing is debt. We mentioned Lee already talked about that we have our debt-free life infinite bank smart banking seminar that we're doing this Thursday at 5:30 p.m. If you want to come, just reach out. We're happy to get you an invite. It's on Zoom. Don't have to leave your house. Starts at 5:30. The first 30 minutes will be talking about an actual presentation of what it looks like and how it works. The middle segment, we'll probably have a special guest talking about something, and the last segment will be an advanced topic or a Q&A session. Um, Other things we've got going on is there's been a big push on, you'll see a lot of stuff out on social media about IULs and about what they can do. They don't tell you the dirty stuff about IULs. So hopefully, whoever, if you're talking to somebody about an IUL, hopefully the one they're talking about is not one that's currently embroiled in a class action lawsuit like some of the big companies out there are with those programs, because the people aren't told the whole story. And that's something that we will do as part of our job when we work with people. And we do use IULs. There's definite place for them if you use them correctly, and they can create some substantial wealth that's tax exempt. And that's the key thing about an IUL is the tax exemption, to be able to use the ability to use the money when you want to, not when the IRS says you can. All right. I know, Dally, you're really good at the IUL size. Anything you want to say about that?
It's 100% up to the person you're talking to, right? So the IUL in and of itself is not a four-letter word. Sometimes you have a conversation with the wrong producer, don't really know what they're talking about, and they're salesmen. They'll flaunt a lower flexible rate in front of you or higher potential gains without putting the whole story together. So for me, I love IULs because from an ethical standpoint, doing the right thing of getting the individual exactly what they're looking for is important. So, the biggest mistakes you can make with an IUL is go in there and tell somebody you want to make a lot of money and then just don't ask for any more information. And the other is just looking for a cheaper way to make more money. Right? If you go in there with, I want to put in $50 a month and I want it to be worth $500,000 in 10 years, uh, glutton for punishment, that guy. So open mind, I love them. I love structuring them the correct way. I know that they're powerful for the right person in the right hands for a certain specific problem. Um, but yeah, there's tons of solutions. It's just one of many.
Yep. Right on. All right. And then I think it's time. Lee, we've
It's
been with
time.
you. I think this is our fourth or fifth year on the air with you guys. And recently we moved out of the area. And so it has become a problem to, just driving and all that other stuff and all that time on the road, to be able to come and do this show, which I love. And this has been near and dear to my heart since I started this, or since we started this, and you've been there the entire way, you and Mr. Fitzgerald, and I appreciate you guys. You've made it very easy for us to get this thing rolling. You've kept it on the track for us, and you guys have given me some great guidance in producing this and being able to put this information out there. So I wanted to thank you, you and Mike. And this is a bittersweet kind of a thing for me. And I know that I've well, it's been wonderful. It's been a wonderful experience, and everybody at NIS is great, and everybody over at Sinclair Communications is awesome. And if you guys had a if you had a station down here where I live now, I would be on it in a heartbeat. Okay, but you don't. So this is our last show, and we are signing off. And we are not stopping. We're going to continue this. It's just we're moving to a national format where it's all going to be weekly podcasts that are going to be the same kind of show. It's the same kind of stuff. And we're going to be, doing the chart reviews and talking about the annuities and talking about retirement planning and all that stuff. It's not going to change. We're going to be doing more of it. It's just we won't be on the radio. It'll be out on, whatever vector the podcasts go out on. So I just wanted to say thank you. And for everybody that's listening, I appreciate all of you folks. Hopefully you got something out of the stuff we've been trying to teach for the last 4 or 5 years. And if you, I hope that you find the financial advisor that's going to look out for you like your family and not give you that, oh, you only have $200,000 to invest. We'll talk once a year and that'll be enough. Hopefully, you're going to find somebody who's going to be a little bit more attentive than that. Speaking of that, last thing, Mr. Daly, we have a new program that we've launched, that we are launching. We launched as of Wednesday last week. And this is that program. I'm going to let you take it. How would you describe that program?
Oh man, I describe it as one of those rare occurrences that you do the right thing for so long that you start talking to the right people and having the right conversations. And I feel like we just had the right conversations with the right people. And it's opened up a world of possibilities for business owners, especially business owners that offer benefits to their employees. It's one of those things that it's a win-win-win as it's described. Being able to give the employers more money in tax write-offs, give the employers more money in a income spike, not cost anything to anybody. It is it's just, to me, it's the perfect storm because you find a group of young men who fine-tooth comb the legislation. They look inside a policy to see what's actually possible, and I think they look at the Affordable Care Act, and the way it was described is there was a lot of stick motivation in the Affordable Care Act, and they sifted through all 1,000 pages of policy to find the carrot. And this is really the sweet spot, the carrot that can lead people into more income, better health, support at the telemed level for your employees. And really, without going into all the details, because I'll let you do that with the numbers, it's a win-win-win for everybody. The employer gets everything they want as far as these write-offs go per employee. The employers get a little bit more money, and yeah, I'm excited to be a part of it and dive into it and offer it to people around the country.
Right. So let me give you a couple bullet points. Number one, it's a tool to help maintain employment for your employees. If they have health insurance, then they're qualified for this. It is a tool that allows them to have access to telemedicine. It allows them to have access to telemedicine without a copay. It is endorsed by the Mayo Clinic. It creates on average $600 of reduced FICA costs for the employer and an increased income of $1,800 for the employee. And the best yet, it costs,
Doesn't cost a dime.
it's just because of some of the carve outs that are built into the Affordable Care Act that this program has been put together to take advantage of. So if you want to know more about that, reach out to us. If you're an employee and you want $1,800 raise, or you're an employer and you want to save $600 per employee on taxes, give us a call.
Once again, 757-278-1264, 1-800-677-0989, and the website, forehandagency.com. From myself, Lee Foster, and Mike Fitzgerald, thank you for your kind words. It's been a pleasure to work with you, and we're going to miss having you on the Mighty 790. Scott Forehand and Jonathan Daly, forehandagency.com.